Welcome to another edition of Real Estate Intelligence. I'm your host, Simon Giannini, and this week I want to talk about something very exciting. We all know the condo market is very robust. We all know that real estate developers are doing really well. But what if you could invest, actually partner with the top real estate developers right here in Canada and make annual returns on your investment of 20, 30, and yes, even 40% per year? Join me in our Toronto studios as we talk with Peter Politis, CEO of Greybrook, who's an expert at doing joint ventures with real estate developers right here in the Toronto area. You know, we get a lot of questions, of course, about real estate investing. And one of the ones that we get a lot of questions on is, I'd like to invest in real estate. I'm not so sure about the idea of managing tenants and doing that whole shtick. So, what are some options for more passive real estate investing? So we've got a great guest in here. Please help me welcome Peter Politis, Greybrook. Nice to have you, Peter.
Thank you for having me. My pleasure.
Peter's here to talk about one of the most exciting avenues of real estate investing, and one that I believe is going to catch fire. It already has for a long time. We're talking about an investment that's RRSP eligible in most cases. We're talking about a passive real estate investment of anywhere from 2 to 4 years, and we're talking about double-digit returns of 20% or more. Now, we can't talk about actual returns for current projects because of securities restrictions, but we can talk about past projects and some of the results. So, we get the most questions probably about this because, everybody knows you can buy a house, you can rent it out, you collect rent, you pay off the mortgage. It's pretty easy. And then there's always the horror stories about, how do you manage tenants and all of that. So we have a lot of clients, a lot of whom are investing just in this type of passive investment. And we have a lot of other clients that are using your type of investment as a way to diversify. But before we get into it, let's talk a little bit about Greybrook, because people want to know, who's this company? So what's your background?
Yeah, sure. So Greybrook is a private equity firm as a group. There are 4 principals at Greybrook. I am one of the 4 principals, and I run a real estate division. We're proud to say that we work with some of the biggest and best developers in the city. We have active projects with Tribute Communities, Fernbrook Homes, Citizen, Empire Communities, Plaza Corp, Castle Point, Goldman Group, Andren Homes, Tiffany Park Homes,
all newbies.
Lakeview Homes. Yeah. I mean, in any business, if you can have the biggest and the best go to work for you every day, you've got a strong possibility to succeed. And that's really our investment philosophy on our partners. We're fortunate that none of these developers need us to be in business. We're kind of like the worst kind of bank. The only people we want to partner with or give some of our money to is the people who don't need our money at the end of the day. And that's really what our partnership is based on, a good financial partnership with a strong, well-heeled developer.
Now, I know you have, but what would cause you to turn down a project or turn down a development or a developer?
Yeah, I mean, there are a lot of different reasons. On the developer side, a lot of it is not just their ability to execute as a person. We're not investing in a person, we're investing in an organization with execution capability, with balance sheet capability, with borrowing capability from the banks. I mean, we're investing in an institution at the end of the day. So it's not about a guy who has 30 years of experience that, can undergo development. It's about a fully integrated developer who has construction, marketing, development. These are machines at the end of the day, not just an individual. On the project side, there's a lot of things that cause us to turn down a project. We probably see somewhere between 110 and 120 projects in a given year, and we'll pick somewhere between 5 and 8 of those projects to transact on. So, what we're buying our land for, what the location is, what our construction costs are going to be, who our partners are, what the time to come to market is, when we can actually start selling this project, what around it is selling, what we can sell it for. So there's a myriad of things that we look at when evaluating and underwriting our projects.
Now, if you're just tuning in, we're talking about passive real estate investing by partnering with developers. And, one of the questions that I get is, you're talking about the biggest names in the business. Do I need $1 million to invest? Like, what's entry-level investment? What's the minimum?
So being a registrant of the Ontario Securities Commission, in order to qualify to invest, you must be what's called an accredited investor. An accredited investor is somebody who either has $200,000 a year of gross pre-tax income as an individual. It can be rental, investment income, et cetera,
okay,
or $300,000 of household income, or $1 million in financial assets. If somebody meets one of those 3 criteria, they can invest as little as $25,000 per project.
Okay.
If they don't, they must invest a minimum of $150,000, and they also have to be suitable to do so in a given project.
Okay, so you don't necessarily have to be accredited. If you're accredited, you can go as little as 25, and of course no ceiling. Yep. If you're not accredited, If you're, normal income, normal assets, what we would call an average person, as long as you invest a minimum of 150. Now, could I do 150 with my spouse, for example?
It would have to be an individual's name. So you can combine an RSP, a TFSA, and a cash account in one individual's name, but it'd have to be solely in that individual's name. It couldn't be a combination of, let's say, a spouse.
We talk to a lot of people that, obviously some have cash, some have money in their RSP, others still have a lot of equity in their homes, and they're thinking about, I can borrow money so cheaply now. I can borrow money, less than 4%, 3.5%, and getting cheaper by the day. Can I borrow equity out of my home and invest in a vehicle like one of your projects?
Yeah, I mean, for us, a lot of the idea is that to us, it's not really relevant where the money comes from. Of course, you have to be able to maintain, if it happens to be debt, to maintain the payments and all those obligations and whatnot. But for us, it's an ability to use any cash or any RSP in order to really partner and own property with these developers, because that's really what we're doing. We're not a lender of money. I don't lend a developer money, he gives me some prescribed interest rate, and off we go. What happens from a structural perspective is we co-own a property with the developer. They put up some money, we put up some money. The developer can never ask us for any more money under any circumstances.
So no cash calls.
We can never be diluted, so I started owning 5% of the property, now I own 1%. And we split all profits 50-50 at the end of the day.
So obviously fantastic locations, the top developers in the country, and now you can be a part of that, you can share in the profits. Call the number on your screen or go to realintel.com to get your free information package. Now join me in studio as Peter Politis walks us through and shows us exactly how joint venturing with developers works.
So Peter, we've talked a little bit about the investment vehicle itself. We're partnering with developers. And, one of the questions that we get is, how is my money protected? If I buy a house is mine. How is this different?
Yeah, so it's not really all that different in an actual form, but a lot of people ask me, what's my security? I like using that word security. And security is really a debt-related word. If I'm lending some money to somebody, what am I secured against? Title to a property. It's a bit different. Take the house example that you just said. If you went out and you bought a house for $1 million and you paid cash for that house, and that's your house. So someone asks you, what's my security? The answer is, well, it's my house. This is very similar. Well, it's our land, it's our property. Instead of it being a house, we're really acquirers of the property and the land. So depending on how much money you invest in a specific project, which every investor gets to choose themselves. So you might own 5%, 10%, 2%, 1%, simply a function of how much money you invest.
We can invest our money. We can, typically double it in about 4 to 5 years, as we've talked about before, and these are past results. But let's talk a little bit about the development process, because I think a lot of people might be nervous to invest in this type of vehicle because they don't understand. I know builders make a ton of money. They have big buildings, they drive fancy cars, and they have lots of advertising dollars. So obviously they're doing well. What is the process that the developer goes through to develop a site?
Essentially what happens is the banks will not give us construction financing to build the project until we've essentially sold enough of the project to already make a profit. So if we didn't sell another unit in, whether it's a housing development or a condominium development, we've already sold enough to be profitable.
So typically 70% of the project.
Approximately.
Yeah.
So if a project costs $100, the bank will give us $70 or 70% of the cost of a project once we've reached that pre-sale threshold. But not unlike when you buy a house, you have to have equity or down payment. So the remaining 30% is split into two things. 15% is purchaser deposits. When someone comes in, they buy a building, buy a unit, they put a deposit. It's bonded and insured, so there's no risk to the buyers, and used in the construction process. So now we have 85% of the cost, 70 from the bank, 15 from the purchaser deposits.
Right.
The other 15% will come from the developer.
Where we come in.
Where we come in. So we put up a portion with the developer, so we're putting up 15% of the total costs of the project. It just so happens that that equity or that down payment that is our responsibility typically equates to buying that property, that land that we're developing from a mathematical standpoint. Then that $100 project, maybe we sell all the real estate in there for $150. So that $50 that's left is the profit that goes to the developer and to Greybrook.
That we all share, because now we're partners with the developer.
Exactly.
So the question comes up as well fairly often, and that is, I get it. I can partner with the developer. But why do the biggest developers in the country need my piddly little $100,000, $150,000, $200,000?
We're fortunate enough that none of our partners need us to be in business. They're all very well financially healed. But in any business, you can do more in partnerships. I tell people, Apple, which has more money than the US government, literally, they have more active partnerships than any other company around the world. You can do more with good partnerships. Absolutely. And it's a very capital intensive business. So I don't care who you are, but just Greybrook and the projects that we've done over the last 24 months, we've put out $250 or $300 million of equity. So no matter who you are, that's a lot of tax-paid cash dollars sitting in a 3, 4, 5, 6, 7, 8-year project, depending on the size of the project. So these developers will come on and take on partners to do so.
So it's not unlike, for example, if somebody's borrowing against the equity in their home and they're paying 3.5%, they know they can invest it somewhere else for 10 or 15 or 20%. You're borrowing at a lower rate to get a higher rate. So is it pretty much the same thing?
It's not because it's not borrowing,
it's not
right?
borrowing, but you're raising capital.
Yeah, I mean, to the developer, it's really irrelevant because we come in as equity or co-owners of a property. So the way they look at it is, if I'm putting up, our typical model is we put up 80% of the equity, the developer puts up 20% of the equity, the profits are split 50-50. So if they can put up 20% of the equity to make 50% of the profits, and they do that 10 times over, they're getting a leveraged return or a higher return on their equity, but without taking on any debt. So for the developers, a lot of the guys that we're working with, they grew up wanting to be Bramalea, the biggest developer in Canada at one point in time. And when our banking system was different and you could lend against land, they saw one of the biggest developers in Canada vanish because of using leverage. So a lot of the big developers these days are paranoid to go out to take on a bunch of debt. They don't want to be living interest payments, mortgage payments.
So they're minimizing risk as well.
A portion of it is minimizing risk, but not so much from a financial standpoint, but from a how I run my business standpoint. I'd rather do everything for cash in my life if I could and get a better return and take on debt, and we allow them to do that.
So it sounds like a win-win-win all around.
It's one of those old-fashioned win-win situations for sure. We like to tell people that the two biggest risk factors in doing what we do are time and illiquidity, in the sense it's not a stock that you just click your mouse and get your money back. But if we take on little or no leverage when we buy the property, and we don't take what's called entitlement risk, so I know that I can build a house or a condo on this property, then someone's going to buy a condo in Yorkville or on the waterfront or a house in Markham or Vaughan or Woodbridge at some point. So if we can afford to wait, we won't start till we've sold enough to make our money. That's why we've done to date 49 development projects, about 13 or 14,000 residential units, and all of our projects have been profitable to date.
I know I've got your attention because we're talking about the best locations in the GTA with the top developers in the country, and we can share in the profits. We're talking 20, 30, and 40% returns on investment per year. You can invest cash, you can invest your RSPs, you can even invest out of your lines of credit. There's a lot of different ways to do this. And the best part is no tenants, no property management. For your free information package, call the number on your screen or go to realintel.com. Now let's go back to studio where Peter Politis and I talk about specific projects and the actual returns they've generated.
Now, Peter, you've been doing this a long time now. Let's share with our audience, what are the different types of projects that you've been involved in?
All the high-rise developments that we do are all in the downtown core. So we focus on major downtown market. We won't go to, let's say, Markham or Richmond Hill or Barrie to do high-rise. Even though there's a really active and real demand for those projects in those areas, it costs the same to build a condominium in the 905 as it does in the 416, but we charge less. So at the end of the day, the developer's margins are less.
Much better, absolutely.
And a typical project length for a high-rise can be about 4.5 years. It can be 4 to 6 years depending on there being multi-phases, but on average about 4.5 years. Then we'll do what we call infill townhouses. So smaller townhouse developments, somewhere between 50 and a couple hundred units, and those could be 2, 3, 4 years. And of course, while those can be in the downtown core, we would go to Markham and Richmond Hill and Vaughan and Oakville to do those kinds of projects. And of course, there's the bigger master plan community stuff where we're buying 1, 2, 300 acres, building 500, 1,000, 2,000 homes over some prolonged period of time. And as you know, there isn't a couple hundred acres just available in downtown Toronto to build houses on. That will obviously be in the suburbs of the GTA.
Okay, so let's talk about a couple of examples of high-rise.
We bought the former Volvo dealership on Mount Pleasant, just north of Eglinton. We put about $6 million of our investors' capital in that project. In about 4.25 years, our investors got their $6 million back, plus $9.25 million more in 4.5 years. So that was their return. So about 6 in, a little over 15 out.
So about 150% over 4.5 years.
Correct.
Simple
Correct.
math says that's a good return.
Simple math says that's a good return.
That's a good return.
So I'll tell you about another development that we finished, and this was a large, multi-phase, 4-tower development in Liberty Village.
Okay.
And I'll tell you, on the return standpoint, basically it was a 6-year project. We got a 41% annualized return for 6 years, which means that
Let me repeat that, 41% per year.
on an annualized basis.
And this was about a 5 or 6 year
It was
hold?
a 6-year project. So
Yeah.
basically, every $100,000 that went into that project turned into about $350,000. We put up a total of $31 million, and our investors made about $74 million.
Now that was an interesting time, I recall too, because I'm guessing it was around 2007, 2008 coming into the project.
Yeah, it's funny because you should say that, because most people who hear that say, well, that project probably went swimmingly and there was no issues and everything just fired on all cylinders to get those returns. And it's actually the exact opposite. We actually bought that property in December 2007.
Yeah.
And then by December 2008, no banks were lending, people weren't buying. We were in the midst of literally the largest financial crisis this world's ever seen in recorded history. So what did we do? We actually closed our sales center for 9 or 10 months. So we told our investors, you know, we're not a mortgage, we don't have to refinance, we don't have to push the sell button. This is good real estate.
So we just have to wait.
We're gonna sit and wait, which we did. Then we reopened about 10 months later. We sold actually about 1,000 units in the next 3 or 4 months thereafter. We started our construction, we built it, we delivered it, and now we've since paid out our investors. So because we're equity and because we're not debt, we weren't otherwise forced to sell at literally the worst time in history, and somebody else would have came in and made an aggregate $148 million between us and the developer.
Which sort of explains to me how builders can wait it out.
The ones who have, it goes back to why do they partner with us? Because if they have good partnerships or they have deep pockets, or they have the ability to hold land, it was good property when we bought it December 2007. It didn't change December 2008. It was still good property, but the world changed. So our ability to wait allowed us to withstand. And that's one of the reasons why we've been so successful. It's not because we're the smartest guys in real estate or the luckiest guys in real estate, but if you have the ability to wait and you know you can build that product on that piece of property, then we know that we're going to be successful.
We talked about Liberty Village, obviously a fantastic development and doing very, very well. What are some other, downtown projects?
Yeah, so on the downtown side, on the condo side specifically, we've recently acquired the northeast corner of Yorkville and Avenue Road. So we bought, for those of you who are familiar, we bought everything from Hazelton Lanes Hotel, or one restaurant kind of down Yorkville to Avenue Road, north to Whole Foods. So that's going to be
Not a bad location.
Probably one of the best corners of real estate in the country.
For sure.
And for us, you know, we paid about $75 million for this corner of real estate. And, you know, some people may have $75 million kicking around and they want to buy that property on their own. Others may not, or may not want to put their entire $75 million in there. That's where we come in. Typically in real estate, the more money you have, the better the quality of real estate you can buy. Not always, but it helps you get what we call institutional grade real estate. So if you're an individual investor, how for 100 grand can you come in and buy a $75 million piece of property? Well, through our partnership structure with our developers, you can own that corner. So whether you put up $75 million, whether you put up $100,000, you essentially own that property, get all the profits proportionally, of course, that you would as if you own the whole thing.
Let's talk a little bit about the infill, because those are shorter term projects. It may be, for some people, desirable to get in and out a little faster.
We recently completed an infill townhouse project at Eglinton and Victoria Park.
Okay.
It was about a 2-year project, about 52 townhouses, some semis and some towns. And our investors saw, in aggregate, a 60% total return for those 24 months.
Again, a very, very good return. I mean, in summary, when we talk about low rise versus high rise, am I correct in assuming then it's a slightly shorter term, obviously, almost typically, and is it slightly lower return for the low rise versus the high rise?
So I would say that your average infill project that's in the 2 to 3 year range will kind of have a low 20s annualized return. Your typical high rise project will have something between kind of a mid to upper 20s on an annualized return. And the longer term stuff like the master plan communities typically will project out to have a higher 20s on an annualized basis.
Okay.
The thing to remember though is that this is not a prescribed interest rate. So we're getting 50% of all the profits. So when the developer makes an extra dollar, our investors make an extra dollar. Our returns are not capped.
So we may have to wait a little bit longer, but our returns are pretty much guaranteed because the developer's not going to do the project unless there's pre-sales, which means they're not going to get construction financing if there aren't. So it's as close to guarantee. And I'm very nervous about using the word guarantee, but it's as close to guaranteed as possible, right?
I don't look at it as I think guaranteed is a funny word, but for me, I know that we're going to make our money. Sometimes it can happen a little sooner, sometimes it can happen a little later. That is the beast that is development. However, I know that someone's going to buy that house, someone's going to buy that condo at some point. We recently did a 2-3-year townhouse development in Markham, near the Markham-Stouffville Hospital. Markham's exploding. For someone to sit there and say that I don't think you could ever sell a townhouse in Markham again, we can agree to disagree.
I think you're okay.
We just recently launched a townhouse project in Woodbridge, just north of Highway 7, in between Islington and Pine Valley there. We sold 65% of the project in 5 days in that case there. So as long as you pick the right locations and you have the ability to wait, our view is that it's very important that you pick these locations because somebody will live there sooner or later if you build the right product.
We all know that location is key. We've heard location, 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 but we also need to have the right partners. And if we're partnering with the top developers in the country and sharing in those profits, that's a beautiful thing. So call the number on your screen, get your free information package, or go to realintel.com. You know, real estate intelligence to me means talking and learning from the best in the business. Peter Politis and his partners at Greybrook are certainly the experts in the field of joint venturing with developers. Let's go back to studio and find out more.
The question that I would get most often is from, the nervous types. Because we describe Canadians as conservative, chicken, and maybe a little cheap. And that's actually served us well because in light of the meltdown in the US and in Europe and Asia, our market continues to march along at a normal, safe pace. But let's talk about what are the risks, what are the downsides for this type of investment?
We like to think that the two biggest risk factors in doing what we do are time and illiquidity, in the sense that it's not like a stock where you just push a button and get your money out.
I guess the only downside is not if we're going to get paid, but when. Is that what you're saying?
Yeah, I mean, if you're doing it with the biggest and the best, they've got it down to a science and not so much an art. So for us, if you ever walked into a development and say, I want to buy this unit and it costs $300,000, you don't put an offer in for $295,000. You either pay the $300,000 or somebody else will. So we're not willing to sell it below the price that makes us the profit that we are comfortable making. So if we have to wait, so maybe you'll buy it, but maybe you won't, and the next guy will or the next guy will, but one of the people who will walk in will be eventually buy it.
Okay, so we're feeling pretty secure about the investment. I've got some money in my RSP, for example. How does this work? Does it come out of my RSP? Does it stay inside of my RSP? These are the common questions we get.
Absolutely. Now, keep in mind, all of our proceeds and our returns come at the end of a project. So we're not getting monthly or quarterly distributions.
So yeah, because this is not a mortgage investment where you're getting an annualized return.
Correct. So at the completion of the project, or when people move into their homes or their condos, then the money comes back and is distributed to the partners. So think about it this way. If you have $100 in your RSP, you own $100 of Microsoft, you bought it, you sold it for $200, you have $200 in cash in your RSP. This works the same way. Instead of having $100 worth of Microsoft, you have $100 worth of the Greybrook Yorkville project in your RSP. And its money stays in your RSP, the security is held within your RSP, and the returns go back into your RSP. So when you get your $2 back or your $3 back, instead of having $1 in your RSP, now you have $3 in cash, and you're free to make another Greybrook investment, buy another stock, pull it out, do whatever you want.
Now I have to assume, somebody's invested some money, 4 or 5 years have gone by, they've gotten their check, it sits in their RSP. I got to assume they're asking you, Peter, where's the next deal? Do I invest my money again?
Yeah, I mean, we currently have 4,000 active investors in 32 countries, and we have a 96% investor repeat rate.
Wow, that's pretty good.
Yeah, I think that obviously the returns have to be there. I mean, that's a de facto, but I think that's not why people reinvest. We report to our investors on a regular, typically quarterly or more frequent basis. We do full financial statements every year from big, large, well-known auditors. My company is very interactive with our investors. We have friends and family evenings where they come in and buy units. They feel very connected. They are the owners at the end of the day. They're treated as owners. And that's really why the experience of what's going on, a lot of times I don't get a question of what's going on in the development. It's just a good positive report goes out. They come back and just call to, hey, isn't that great news? That's going well. And it's more of they're always informed at the end of the day.
Now, I know a lot of you are watching and saying, you know what, this sounds good. I've still got questions, but how do I find out more? Well, it's very simple. You go to realintel.com or you call our help desk, 416-366-9090. We'll get you more information. And so people go to the website, Peter, they call, we're going to connect them to your team. Then what happens?
Yeah, so somebody from Greybrook was happy to walk through a specific project with somebody, answer any questions they may have. And the reason we talk about a project is because all the structures are the same. Who does what, who gets what. The property is obviously going to change, the developer can change, but who does what is always available there. So we'll walk them through and answer any questions they have, and they'll see that once they understand the general process of how we work, all projects are pretty much cookie cutter from there.
Now you look at how many projects a year and then how many do you actually choose? Because I know you're very, very, very picky.
Yeah, we'll see somewhere between maybe 100 to 120 projects in a given year. And we'll do somewhere between 5 and 8 projects in a given year. I wish I could find a project that had the margins and the risk profile that we look for every week, and that would be great. But unfortunately, we only do somewhere between 5 and 8 projects in a given year.
Okay, so if I had a preference, for example, if I wanted to do something shorter term, I could always wait for something shorter term to come up.
Yeah, that's
or longer term.
That's exactly right. It's one of the benefits is that you as an individual investor can choose the developer, the location, the time horizon that you feel comfortable in. Obviously, if we're doing it as Greybrook, we feel very strongly that it should meet people's needs. But some people may want to invest in a 5, 6, 7 year deal. Some people may want to invest in a 2, 3, 4 year deal. And that's really the individual persons to choose.
Okay, now if I'm investing in cash or borrowing funds from a line of credit or so on, it sounds pretty straightforward. Is it a little bit more complicated if I'm tapping into my RRSP or RESP?
So what we did was we created a full operations team that will ask you a few questions, fill out the papers for you, ask you for a few signatures, and they'll coordinate with your bank.
That I like. So they'll handle all the paperwork for me and figure it all out?
They do it for me too.
They do it for you too. Okay, good. Yeah, and I've had experience with your team, and obviously very very positive results, and very professional team. If I can give you my 2 cents. But again, I guess the process then is just to find out more and find out, what's the next project. If that project's for you, fantastic. We can get you invested right away. If that project is not for you, you can wait around for the next one.
Yeah,
low rise, high rise.
A little bit about our pipeline and a little bit how the legal documentation process works and all that.
Okay, great. A ton of information, Peter. I know we're going to have you back.
It'll be my pleasure.
Because what I know is we're going to get a flood of questions, and we're going to try to answer those as much as possible on the website. And again, even if you just have questions, you're not sure, we'll connect you with Peter's people. We'll get all that information to you, and we'd love to be partners with everybody out there that wants to play in this game, because it's done wonders for our clients. Obviously,
it's done wonders for me personally. I'm one of our biggest investors personally on every project, and it's on the same terms and conditions as everybody else.
And 96% repeat rate, I think, speaks for itself as well.
Absolutely.
Okay, nice to have you, Peter.
Thanks for having me. My pleasure.
Thanks for watching. I hope you got as much out of it as I did. And I just want to remind you that for any questions to do with real estate, you can call the number on your screen, or you can go to realintel.com 24/7. I'm Simon Giannini, and I'll see you on the next Real Estate Intelligence.